Yeah, definitely. And there's lots of, I guess, measures that people use, or sort of, I guess you could say, pieces of data that people use to analyze markets, inflation. You could say PMI, or GDP growth, all these other factors, consumer spending. Is liquidity, I guess, linked to that, or is it its own thing?
Well, yeah, exactly.
Yeah.
It's a stage before. I mean, these things are a derivative, and what you've got to do is to think of the sequence here. The sequence is very much that liquidity is created, and it's either created directly by central banks. They are, in fact, increasingly playing since in the last 10 years a bigger and bigger role, and notably the Federal Reserve in the US. Then you've got banks, or what are called shadow banks, which are doing, if you like, wholesale banking. Those entities can create credit. Those are the sources of liquidity. They may be embroidered on top of that by cross-border capital flows coming in, but all these are sources of money to be spent in financial markets. That money drives asset prices higher. It will spill over first from, let's say, fixed income and equity markets into real asset markets like housing. So housing is a derivative of this as well. And then ultimately it will move into the real economy. As it hits the real economy, economic activity will begin to go faster. And then if there are capacity problems, inflation will pick up. And that's pretty much what we've seen this cycle. The big difference to note between this cycle and the 2008-9 global financial crisis cycle was that in the wake of the GFC, central banks injected lots of liquidity into financial markets, but it did not shift from financial markets into the real economy at that stage. It stayed largely vested within financial assets. And so you got asset bubbles, blown up after the GFC progressively through the last decade. It didn't really impact real economies very much, but the COVID crisis changed that. And what you saw at the time of the COVID crisis was a dual effect. Central banks injected lots of liquidity into markets, as they had done before in the wake of the GFC. But on top of that, governments, through their furlough programs or income transfer programs, income support programs, actually pushed that money into retail bank accounts. So, the likes of you and I actually had more money to spend. And that then drove the real economy faster. And then we've seen the recent clash involving, energy supply problems, and hey presto, we get inflation.